Hey, welcome back. We are here at the All In Podcast headquarters here in Franklin, Tennessee. And I got my great friend Brian Yormack here, specialized tax strategist who does a lot of things. We just got back from an investors meetup last night. But two of the things that Brian's going to talk about today, which is really going to really hone in on your tax strategy. So we're going to talk about what it means to be all in with the knowledge of your tax strategy. So if you're a business owner out there, you're an investor, especially for real estate investors, but also business owners, we're going to talk about that. So today we're going to cover a few things, but Brian, thanks for coming.
Yeah, man.
Good to see you.
Thanks for having me.
So Bay Specialized Tax Services, tell a little bit about what you do and kind of a couple of things we're going to talk about today.
Sure. So, when people think of specialized tax service, you kind of have to remove the idea of, filing taxes, your bookkeeper, even CFOs.
Not talking about that stuff, right?
We come in not talking about that. We come in and do narrow pieces of the tax code, normally along tax breaks, benefits, incentives, programs that come out when there's new law. We're in charge of kind of being on top of that so that we can help your current staff kind of get these things filed.
Right. Right. And so one of the big things for investors is they want to know how to properly depreciate. So there's this thing called depreciation, guys. Those of you are in my audience, a lot of you are realtors or real estate investors, and you're trying to figure out how to mitigate your income taxes. So you hear these people that are paying very small single-digit numbers on their property, or maybe mitigating all of their income taxes. How are they doing it? Well, I'll tell you. When you own property and a cash flow producing property, you get the benefit of depreciation. So the government just says that the property is depreciating some form of amount, and they allow this little tiny amount to be taken each year. Well, now they have what's called bonus depreciation, which is live right now. And what it means is that they're allowing you to use a lot of the depreciation in the first year of the things that are not attached to the house itself or the commercial property itself. And so what happens is you get this big tax deduction. Just to dumb it down, you get a really big tax deduction, which then can be used to offset your actual income from your real estate income, and sometimes even your W-2 income, if you can show that you are spending a certain amount of hours managing that certain property. And we'll get into that, but is that pretty much what we're talking about here?
That's exactly right. So what it looks like is we all know that real estate, appreciates for the most part in value. But as far as on paper, we have to be able to show that it's got a useful life. So what that means is that you've got to take this depreciation over a period of time. So if you buy $1 million property, you're going to have to wait 27 years to write that off. What this accelerated depreciation does is it says, okay, well, maybe 25% of that is going to end up being not part of the building itself. So instead of that long life, we can take it into a short-lived asset, and that short-lived asset can get 25%, so $250,000 of a deduction in a first year.
Right. So let's just take, let's say an apartment building, whether it's a quad or 5-unit, 10-unit, whatever. But let's just use a nice, round, easy figure, say $1 million property. Okay, so somebody's bought $1 million cash flow producing property. Could be a single unit down at the beach, or it could be a quad or whatever. So they've bought this property. They should come to you when?
Well, right away.
Almost immediately, right?
Yeah, I mean, right away. If they've already bought it, that's a great time. Right when you've signed the actual contract, you've got it under contract, we should start to have a discussion, because this is a tax planning item that the sooner we get it done, the sooner that you can stop paying estimated quarterlies on that net income. We can go back many years. If you didn't get it done right away, you're still eligible. But the benefit's going to come the moment it's yours and that asset's placed in service. You should be looking into getting a cost seg, at least estimate.
In a cost segregation study, so you get an estimate, and the bonus depreciation would typically be around what, 25% on average?
I think 20 to 30 is a good
20
range.
to 30. So we're talking about so to put that into dollars, that's $200,000 to $300,000 in a tax deduction. So if that person in real estate had made $200,000 or $300,000, or they made $100,000 net on that property in income, they're able to use that and offset the income until that's used up. So they may not use the tax deduction for the first year, but it rolls over to the next year. And this is why you have politicians that are, back when Trump and Hillary were fighting on stage and they're arguing about this. That's what they're talking about. They're talking about not paying income tax, and the reason why that it's legal is because you own buildings. So the government rewards you for owning buildings that are cash flow producing because of how many jobs it creates by that one cash flow producing property. So you may as well take advantage of it and play by their rules. That's what we're talking about here, right? I mean, it's a massive savings. And I think I've seen people on appointments with people who own a $50 million motel or hotel, and their CFO didn't know about cost segregation, and that costs that person tens of millions of dollars in tax deductions, and that CFO gets fired on the spot. It's amazing. So, I mean, these are big things we're talking about. So whether you're a small investor, you own a few rental properties, or you own, millions of dollars worth of properties, you need to know cost seg. And if you think you know, you still probably don't know, because you probably are getting low-level cost segregation studies done, and they're missing lots of things. I've seen this. It's irritating, and because I see people get money that they've left on the table because they get a $3,500 cost seg study done, and which is dirt cheap. And it's like going to Walmart to do something when it's your money. So you don't get your taxes done at Walmart. You get your taxes done by a top-notch person who gets you the most back in the legal way, right?
I mean, I do. I would, right?
Right.
And a good way to kind of break down what you're saying for your audience here is, let's say we've got a $400,000 property, right? So you don't need to have a multi-million-dollar property for this to start to make sense. At a $400,000 property, if you get 25% of that, it's $100,000 in a first-year deduction. And how is that applied? Well, let's say that $400,000 property is only making $50,000 a year. That means at $50,000 in year one and $50,000 in year two, for that 2-year period, you've paid no income tax because you have a deduction. You have this business loss sitting on your, balance sheet waiting to be taken. And as you kind of move through the years, you will take it until it goes to zero. It's got a 20-year carry forward period. Normally, I would say most assets after they're cost segged have a 2 to 3 year period of running income tax free.
Right. So that's huge.
Yeah. I mean, if you're not hearing that, that means that whatever you paid in taxes for that income is nothing, zeroed, because it's going to depend on your tax bracket with how much that actually gives you. If you're in a 20% tax bracket, it'll be different than if you're in a 37% tax bracket. But I think we all can agree, regardless of the bracket, we would rather start a business and have some operations up front to get that cash flow in tax-free in the beginning.
Right. And so not to muddle the water, but like that, between that and people who use the strategy of like Felipe Mejia and others who pull out money from their properties, whether it be a home equity line of credit or line of credit, their commercial properties, whatever, that's tax-free as well. So the whole idea is, you're paying taxes in other ways. I mean, you're paying sales taxes, you're paying taxes on property taxes, you're paying a lot of taxes.
Employment taxes. You're still paying taxes.
You're still paying taxes. But when it comes to income taxes, you can mitigate those. And you can pay by doing cost segregation studies, getting the big tax deduction. And then obviously when you draw money out on loans against these properties, that's tax-free money. And so this is how people get ahead.
1031 back end.
1031 to exchange.
There's a lot of strategies that make this all kind of move together with one another, kind of puzzle piece in to make
1031 exchange, guys. You remember that? That's where you have a property, you're selling it, and instead of paying capital gains on that property, you identify another property and you agree to close on a property within 6 months, and you roll all of the proceeds tax-free now into the new property. And so you're just kicking the can down the road. And so just deferring the tax. Now, someday, if you ever sell the property or if your heirs sell the property, you may have to pay the tax on it. But here's the thing, until you do, you're just deferring it. And so that's the beauty of it, of the tax code. And people just need to know. I think this is so important because people need to understand the benefits that they have for the tax code.
Yeah.
And if that's what's the idea here is like, here's what's available, guys, use it. And I feel like that's so much of what you do is like between that and the employee retention tax credits, which we'll get into a second, is people just don't know. They're like, they just hear noise. And that's where I think you just got to understand, look, this is what the code is. This is how you don't pay income tax. Do you not want to pay income tax? Then listen. Okay. Right. I mean, this is how you do that in a legal way. You own property, you get cost segregation studies done on those properties, and that gives you this huge tax deduction, which offsets all the income from that property and possibly the income from your regular income job, especially if you're a realtor. And then sometimes, even if you're a W-2 employee, there's conditions with that you have to meet, so forth, but people are doing it. So that's huge.
Yeah. And I think if anybody's confused about, hey, if I'm going to pay it anyway, why would I defer it? It sounds like a lot of work. You have to remember that if you can keep that $100,000 deduction is going to, give you, let's say, $30,000 of cash after it's all
because
said
your
and done.
tax bracket, say tell us how you got that.
Yeah, a 30% tax bracket.
Okay.
If you get a $100,000 deduction, 30% tax bracket. So at the end of the day,
it's 30 grand real dollars.
30 grand cash
that you didn't have to pay,
right?
That you got to keep.
That you end up keeping. And what happens, and the trick to all of this that people, sometimes don't really understand until they start to implement all of this, is all of a sudden your cash flow is doubling or tripling over a 5-year period. Because if you keep implementing this strategy, if you're paying 30% every year,
yeah.
This
is a snowball effect.
It adds.
And this
exactly.
is how people get ahead. And
sure.
So you can imagine when people have, they go from owning $1 million worth of property to 10 million and then the 20 million and then the 50 million, like Ryan and Jess and people like that. It's like, this is how this happens.
It's definitely part of it. This is a big piece of it.
A lot of it. So guys, if you own rental property, you own commercial property, you need to have an analysis done. You need to have a cost segregation study. Brian can hop on a call with you and kind of go through that with you and see if it's a good fit for you, explain to you the cost, the upfront cost to do it. Nothing's free, but here's the deal. If you give Brian $1 and he gives you back $10 as an example, would you do that deal? Those are the types of things we're talking about. I'm not sure if those are the exact numbers.
The ROI is, that's not far off from sometimes what we see. And it does scale 1-to-1. And our fees don't scale 1-to-1, so it becomes even more lucrative in the $1 million+ price range. But
because it's the similar cost if it's a $2 million property versus $8 million property.
Might get up to $60,000 on a $60 million property, right? And so it just doesn't.
But they're saving. If somebody owns a $60 million property, and then they're saving how much in income taxes?
Maybe $15 million.
Right. And so this is how these politicians don't pay the income tax, and that's the reason why they don't want to show their tax returns. And listen, this is not a political discussion at all. I'm just telling you this is how it happens, and this is the reason why people on both sides of the aisle use the tax code in this way. So let's jump into employee retention tax credits. Now, this is what I think of when I get this. I get these calls about once or twice a week, 3 times a week, and it's an 800 number calling, hey, you qualify and your employees, qualify for employee retention tax credit, you for $35,000. And so obviously you just delete it, but this is a real thing. It's not a scam, and they're making money off that. Clearly, it's why they're trying to get you to call back.
Yep.
But why should they come to you? What is ERTC? It's employee retention tax credits. What is the simplified version of that? It has to do with COVID, right?
COVID, yep.
Right. And so tell us about that.
So a good way to kind of outline this program, if you think of cost segregation, you have to own a building and it has to be a business asset. If you think of employee retention tax credit, you have to own a business that had employees. So that's kind of the first layer of what you need. Then as we kind of go through the different steps, you've got, there's a lot of rules that we'll kind of skirt around, but in general, 2019 in operations into 2020 when the pandemic hit, you were affected by it, either by your revenue or some shutdown orders. And through being affected by the pandemic through 2020 and 2021, they have quarters that can qualify. And if you qualify, your employees per employee get paid a certain amount. For 2020, you're looking at about $5,000 per employee. For the year, you're looking at a cutoff too. And then in 2021, it's $7,000 per employee per quarter.
Okay, so let's just start back. So you've got a business. If you have a business and you were affected in COVID, you had a business with employees, is it because you lost the employee, or it doesn't matter if you lost the employee or not?
You have to, think of the name with employee retention tax credit. The reason this came about is because so many people were getting laid off. The government is thanking you for keeping your employees.
There we go.
So if you retained your employees, in essence, you didn't let them go on to unemployment.
They're going to give you a credit for doing that, a tax credit. Not a deduction.
Not a deduction.
So a credit is way better than a deduction. A credit is giving you money back. It's off your bottom line.
It's $1. It's considered a dollar for dollar credit, which means if we can get a $5,000 credit, that's a $5,000 check.
Right. You're not multiplying it by your tax bracket.
Below the line.
So a guy out there had 5 employees. He kept them during COVID. He doesn't know anything about what this is. He's got 5 times 7. He's got $35,000 out there that the government's willing to give him. Correct? Roughly? Is it $7,000 or something like that?
The problem with this program is how many times they change the law. An easy way to look at it is for all the eligible quarters, if you can get as much for one employee as possible, it's $26,000 per employee for the duration of the program.
Got it. So it's a lot of money on the table. And
it's a lot of money on the table.
Yeah.
That's why these people have money to, be putting marketing efforts and all the rest of that out there. And another interesting thing, Mark, they thought about 80% of small and medium-sized businesses would be eligible. And at this point, they think roughly 20% of the eligible businesses have claimed the ERC.
Wow.
Yep. So billions of dollars on the table.
And so, this money needs to be used up. people are using it. And you think about it, guys. You had a business, and maybe everyone was struggling. Some businesses popped up and did really well during COVID. Delivery businesses, Amazon, but the most of us, the masses, you had some issues, and so now is a time where these kinds of ideas, these kinds of tax credits can actually be captured by you. And you can go back and mitigate some of the losses or some of the hardships that you had during that time. I think it's an amazing thing.
Especially if you start to look into some of the sectors, restaurants, hospitality, there's certain areas that are impacted that are very easily able to claim these, because it's not just, there's 2 kind of ways to do it. One's going to be off of a reduction to your revenue compared to 2019 numbers. But the other one is if you were shut down, had hardship in the sense of not able to get supply chain issues. There's a lot of other ways to qualify. And I think what happened, Mark, is when the first round of these kind of ERC program rules came out, they were actually a lot more strict, and they've opened it up over and over and over. A good example of that too would be the Paycheck Protection Program. A lot of people received money in the PPP. That was a forgivable kind of loan to a grant. And they thought, well, if I received this, I'm no longer eligible for the employee retention tax credit. And they would have been right until they flipped that. So you have, I think, about half the people I talk to at this point say, well, we're not qualified. And if I kind of get into it and ask why, they'll say, well, we received PPP money. So it's worth revisiting. If you've heard of these before and you maybe were told you didn't qualify, it is worth having a second look.
Right. So people just need to take 5 minutes, stop what they're doing. So first of all, guys, if you're listening out there at the podcast, you want to watch this on YouTube at Mark Neely Home, but like and follow there. However, you want to stop what you're doing if you don't know what cost segregation study is and you own rental property, any kind of cash flow producing property, and you want to get Brian an email or follow him. So how would they reach you for that? What's the best way?
I'm happy if you want to leave my information kind of in the link below type of situation. Yep. But I mean, and you're right. As far as these things go and how hard it is to dive in, you're looking at probably 5 or 10 minutes of having somebody, especially if they specialize in these things, have a quick look. You may have to supply some information, takes maybe 20 or 30 minutes, have a professional review it. And at that point, I mean, if you're not qualified, we're not going to tell you that you're qualified.
Right.
You know, it's a very simple discussion of yes or no, and then you can decide if it makes sense to move forward. Especially with the ERC side, that's very black and white. With the cost segregation, another piece of that is that if you're wanting to learn and become a sophisticated investor, it's best to learn these on smaller projects anyway.
Right.
Understand how it all works before you hire, at that higher level and the larger projects.
So website, bay.tax.
Yep. Right. www.bay.tax.
Bay.tax. And Instagram, b.a.y.tax. And so employee retention tax credit. So secondly, obviously, if you are a business owner and you had employees that were working for you during COVID, you need to reach out to Brian and see what money is available for you. Free money back to you from the government. Everybody likes free and everybody likes money. So there you go. It's a double bonus. So Brian's actually got a couple of handy tools for you to use. I'm going to pop those down right into the comments down below here on the YouTube, but tell us kind of what they can use here to sort of help them see if this is a good fit for them.
Sure. For the ERC, it's just a spreadsheet, fill out 3 columns, gross wages, number of employees, some basic questions if you took the PPP, and that'll kick out a number. And for the cost seg, if you fill out what we've got there, you can send it to us and we'll do a free estimate and come back with some real numbers that we can talk about.
Cool. So guys, use these 2 tools down below and then reach out to Brian. If you have any specific questions, drop them in the chat below and we'll get back to you on those. And we're so glad that you joined us today. This is really important information, you guys. This is one of those things where new information can be the difference between how much you make this year and how much you don't make this year. It's a big difference. It can be huge, and this is what the people in the know are doing. So, right?
Yeah, man. Thanks for having me. I'm excited.
So thanks, guys. Thanks for tuning in to another All In podcast, and we'll see you next time around. Till then, be cool.